One of the big concerns during the day, of course, has been whether the budget last night's actually going to fuel inflation. I mean, I've seen every view on this today. There's a lot of claims that it might indeed lead to more interest rate rises next year, perhaps as many as two. Let's have a listen to Treasurer Jim Chalmers denying all that today.
Really the defining influence on our decisions around the cost of living package, our decisions around the growth package and the historic restraint that we've shown in spending has been this inflation challenge. And we are supremely confident that the budget that we handed down last night will take some of these cost of living pressures off without adding to inflation.
Well, the only bank, the Commonwealth Bank, was the only bank that last time got the interest rate rise tipped correctly. Gareth is that bank's head of Australian economics. He joins me from Sydney. If you had to answer in a word, Gareth, whether the budget from last night is likely to add fuel to the inflation fire, what would you say?
G'day, Steve. Look, the single word would be no, but I should probably expand on that. I think the budget last night wasn't disinflationary. In other words, it's not putting downward pressure on prices growth, but then by the same token, it's not adding to inflationary pressures in the economy. And so at the bank, our assessment basically of the budget is that it hasn't shifted the dial in terms of the economic outlook. We've maintained our profile for inflation from here. We think it'll actually come down a little bit quicker than the government's expecting and the Reserve Bank. And we haven't changed our call in terms of the outlook for interest rates as well. So on the whole, there wasn't any surprises to us in the budget. The government is not playing a major role in terms of demand management in the economy. But I think from an inflationary perspective, the budget last night didn't put further upward pressure on demand in the economy.
So when you look at that graph on inflation that we saw in the document where, it's sitting at 7 now, and I think they're predicting that by this time next year it will be down in the 3s. Gareth, do you think that's a realistic assessment?
Yeah, look, we do. We think inflation's going to end up coming down relatively swiftly. That annual rate takes a little bit of time to come down because the annual rate is really a function of 4 quarterly changes. And so you've got to wait for these bigger numbers that were in the data from last year to drop out. But when you think about what the Reserve Bank's delivered in terms of the number of rate hikes they've put through, how quickly they've put them through, some 375 basis points in 12 months, that's going to have a really big impact in slowing the economy from here. And in fact, there's some organic tightening still to come in the pipeline to the extent that there's a lot of home borrowers out there who are sitting on these ultra low fixed rate loans that'll be rolling off into much higher floating rate mortgages as we go through this year. They'll then, by extension, have to change their spending decisions, and then you'll get that slowdown in the economy. As the economy slows, you'll see prices growth slow. A lot of the inflation that we really got up until this point was because of that huge fiscal stimulus to deal with the pandemic. The impact of that is starting to wash through, and we actually agree that inflation will end up coming down relatively swiftly over the next 12 to 18 months.
I guess the thing we don't have control of, Gareth, is global events. I mean, we have to be hoping that there can be some resolution in the Ukraine-Russian conflict and that the American economy continues to see their inflation rate going down. We may not be able to actually rely on all of that, though. I mean, we could be in a position where if things got worse in that conflict, global economy could drive our inflation the other way, right?
Look, there's lots of unknowns. I mean, I think it's worth, when you think about the war in Ukraine and the impact that's had on prices, that has really been an upwards adjustment in a level sense, but you're not getting the ongoing impulse coming through from ongoing lifts in prices. If you look at the global picture from a goods perspective, what we've seen is that shipping costs have come down. That's acting to drop the rate of goods inflation. That's pretty much a global story. And the other thing we've got is basically global central banks acting in a coordinated way to tighten monetary policy in order to bring inflation down. I mean, the key risk in all of this is that the central banks don't go too far and end up delivering both a drop in inflation, but also a hard landing in terms of unemployment going up too much and ultimately a recession. That's the situation the Reserve Bank is in Australia is sitting in, where they want to engineer that soft landing. They've put a lot through. They know that it'll have a lagged impact as we go through this year. That's why we think at the Commonwealth Bank that we're pretty much at the top of the rate hike cycle, and the next move is more likely to be down than up. But I think over the next 2-3 months, there's still a chance that they do actually increase the cash rate. I don't think that budget in and of itself would do that, but I think we need to all keep an eye on the Fair Work Commission decision regarding the minimum wage. There's a risk here that if the decision is an increase in the award wage, anything like where headline inflation currently is, which is 7%, that we'd end up with inflation that would prove too sticky, and the Reserve Bank would have to go that little bit harder.
Gareth, Ed, I love your optimism. I hope you're right, mate. Thank you very much for joining us. It's always a pleasure to chat to you.